Now I'd like to introduce to you our first speaker, and it is my pleasure to introduce Ijlal Ahmed Alvi, the Chief Executive Officer of the International Islamic Financial Market, IIFM, our partner in this workshop.
Thank you, Stacey. Thank you so much. Indeed, pleasure. Bismillahirrahmanirrahim. Assalamu alaikum to everybody. Very good morning, afternoon, and evening, wherever you are. It is indeed pleasing, and we are pleased at IIFM to jointly host this Islamic MPA workshop. IIFM-BAFT participation agreements were published during 2019 after more than 1 year of Academy's Sharia rulings. The participation agreements in this, or the participation in the context of Islamic finance is between the arrangement between the grantors and financial institutions, which is, or the participant, which is generally the case in the conventional also. It is based on the risk-sharing basis. Both arranger and participants take obligor risk, so that will be also explained by the legal counsel. The party execute a separate agreement pursuant with financial institution offering the risk participant's capacity of the grantor sell part of his exposure under documentation to another financial institution with the accepting such participation and capacity as a participant. Next slide. If you compare it with the conventional MPAs of BAFT, the funded and unfunded are included under one agreement. From the perspective of Islamic finance and the guidance we receive from the institutions, and in order to have a clear transparency, which transactions are to be included and what the counterparties are entering into, there are two separate participation agreements. One is unfunded participation agreement, which covers transactions such as LC confirmations, letter of guarantees, and similar instruments. The participants under separate arrangement, which I'll explain, will bear the risk of an obligor. That is another something which we will discuss briefly. I will cover that. The funded participation is a separate agreement itself. Both agreements are based on the wakala arrangement, which is agency agreement. And this is something which we have to keep in mind how this arrangement works. And we also have to see, there is major differences, and I'll explain in terms of, guarantee fee, whether you can do it directly or in case of unfunded, there is upfront fee. So that is something which here in this context of Islamic MPAs, it works differently. As I mentioned, these are early 2019 were issued with the objective of providing solutions in terms of lack of credit lines based on the recommendation of our respective member institutions of BAFT and IIFM, risk coverage capacity and optimization of asset portfolios. That's one of the key considerations when we were developing and assisting and expanding the business of Islamic finance within local and international network of banks and financial institutions. The key features for both funded and unfunded, which are the common key features, which I would just like to cover a few points which are there, is the vast agreement in nature and provide mechanism to include general and specific terms and conditions to be entered between the grantor and the participant. Again, it's not a transaction document or product specific. We have mentioned what type of products can be entered, both for unfunded and funded, but it is up to the institutions to include the type of Sharia compliant transactions they can include as a product. The internal approvals they may have, or the centralized Sharia boards may have those approvals for certain products. Again, the transaction document is not part of this participation agreement, so what you agree, grantor with the obligor is not part of that. Agency wakala-based structure is being used, and that is something which is a critical aspect of these kind of arrangement when it's come to Islamic finance. There will be, or there are 4 parties involved in participation transactions: the grantor, the participant, the obligor, and the beneficiary, and also which has a link with the supplier. Amendment and restructuring, this is some of the sort of aspect which when we were developing the standards, we have to really closely assess and get the feedback whether the restructuring, or in case of assignment transfer at the secondary market, if the guarantor or participant want to sell part of its exposure to other parties. So it's already entered, the transaction is entered, and then they want to basically invite another participant. So this is, or participant want to do the sub-participation, for example. So this is, we sort of, after a great deal of consultation, we have included that is possible and it is doable, subject to that you have Sharia compliant principle and rule to be followed. And basic concept which you have to keep in mind when you are sort of assigning to or bringing another counterparty to it as a participant will be that there will be no discounting. So generally, when you have, let's say, LC confirmation, or if you have funded transaction, you will be doing it at par. So this is something which we have to keep in mind when we are sort of trying to bring in the assignment aspect. We also have a governing law and jurisdiction. So at the moment, this is developed based on English law. And like the case, and then there is a reference simply to London Court of International Arbitration and Dubai-based International Islamic Center for Reconciliation and Arbitration. But as far as normally the case with any standards we develop or other standard setting bodies they develop, the governing law choice is always with the counterparties which governing law they would like to adopt. I have seen a question, although questions will be covered in the later part of this session, but what I would like to say that at the moment we don't have a legal opinion for this. So this is subject to, as we go along, when we receive recommendations for respective members, then something which we would be looking at. We have provided always the case extensive footnotes. So these are also provided as a guidance, which are kept in the forms we provide, but then the institutions, when they are dealing, obviously these footnotes are taking part of when they're signing the agreement itself. And it carries IIFM Sharia Board approval. Permitted, like I mentioned earlier, trade finance transactions, so not all the transactions which may exist in the international markets is permissible, but we have sort of key instruments which are there, like letter of guarantees, irrevocable reimbursement undertakings, letters of indemnity, letter of, or similar instruments can be included, and there are approved Sharia compliant transactions. One aspect which I briefly mentioned in the beginning was justification of participation share in the participation fee or upfront fee in case of both funded and unfunded. So what you have to see in Islamic finance is you're not really can pay the fee for guaranteeing. So if you're guaranteeing an exposure, the grantor or the participant cannot directly pay the fee, the grantor, to the participants. The reason is simple, like from Sharia perspective, it is not allowed to because it leads to like interest-based transactions, which is not allowed in Sharia and Islamic finance. Then you look at it from the permitted trade finance transaction. For funded, you have certain contract which I have mentioned, like mudaraba you can do, or you can do musharaka. These are more sort of equity type contracts. Then you have ijara or murabaha, which are more sort of a element of debt in them. So they have, you can have a fixed rate on those. Then there are instruments or contracts which are like musawama, salam, which are similar to muraba. At the moment, we don't have time, but when we do a detailed workshop, which IIFM is also planning to do in future, we can go into these contracts also. And these are, I think, readily available these days, the description of these type of arrangements and contract. Looking at this equation or sharing participation upfront fee. So this is specific to the funded participation we are talking about. So like I explained, there has to be certain services to be performed for the grantor to pay to the participant the upfront fee or share the upfront fee. So this is also something which I think is a major consideration. Other thing we look at from the important consideration point of view, general Sharia ruling when we look at in risk participation, so the transaction itself should not have any Sharia repugnant obligation on any party, such entrepreneur or palentry in case of default. So these are not really something which is allowed in Sharia. So what you can sort of claim, either your share of fee, or you can share actual cost. So this is something in the agreement we have clauses defining this. We are also looking at in terms of bringing about the insurance aspect. So it is preferred to use the kaful Islamic insurance, and generally it is now available. But something, if not available, then based on internal approvals, the parties may agree for normal conventional insurance as well. Now we are looking at Sharia rulings in terms of and the basic principle between when there is a guarantee involved, and how to basically share the risk exposures in between us. So there is we have to look at it from the grantor naturally issues, let's say LC or LG, and the names of other participants as a collective agent, and other participants agree with them to be part of this arrangement with the obligo. And the risk, what it is basically takes is it takes its own share behalf and as well as from the participants as well. Looking at the next slide, we are looking at funded transactions. So funded transactions, generally what we have seen in the market, what is most of the transaction is in various jurisdictions take place between the Islamic institutions or Islamic banks and international banks having Islamic component in their operations. They use the murahaba concept. And murahaba, we have to be mindful how it works. So I have explained there that actual goods has to be there. The grantor would have to, take the possession of the good from the supplier, and then it has to give it to obligor. And then there is an element of basically profit component and the principal component and the exposure between Islamic bank and conventional bank. They basically share this funded part. And we have to keep in mind that when the institutions, when we had these two separate MPAs, when we developed, one of the reasons was the main reason was explained, was that the institution, particularly Islamic, they prefer that they don't really commit at the same time when they are entering to unfunded portion let's say LC confirmation, and then they also will commit at the same time that they may be entering into funded part. So they may just take the funded part of that what the grantor is offering, and they may not take part in the funded portion when the funded requirement comes from the obligor. So this is one of the reasons why you have two separate, so that works well in terms of how the Islamic finance we operate, that there is sort of exposure management from the Islamic institutions. One of the key sort of things which IFM we also refer in our standard development process, although we have our own working groups and we develop extensively consultation of institutions, their market, their operational, their Sharia and the legal departments, as well as IFM own Sharia board, which basically provide guidance and provide approvals. But what we also refer to is standards from other Islamic standard setting organizations such as AOFI, which is associated with accounting and auditing organization for Islamic financial institutions. And they have, apart from accounting and auditing standards, have Sharia standards, which most of you, I'm sure, would be aware, which are there. So we use those standards as a reference, apart from fiqh academies, which issues from time to time certain rulings in terms of Islamic practices. And these are sort of now what we are looking at, the AOFI Sharia standard number 5, when it's come to how the guarantee aspect work. So we bring in the concept of kafala, and that kafala arrangement is a separate arrangement. So it's not part of the agency. Agency itself, you cannot bring in, because it's like I explained, it's more of an equity type contract. So you cannot really bring in the element of guarantee in equity arrangement, in equity type arrangement such as wakala arrangement between the participant and guarantor. So you have to bring in as a third party as a separate arrangement, which we have provided in our agreement. So there is a Schedule 2, if you can refer to that, and you can see that there is a Schedule 2 for which is form of demand for payment in case we hope it doesn't happen, but it's the market, so there is an element of we have to take into account that if default happens, then this has to Schedule 2 is triggered, and this is where the arrangement is. This participant is providing as a third party a guarantee to share that responsibility of paying to the what the obligation grantor or obligor had to pay to supplier, for example. So this is something which we use AOFI standard 5, and we have sort of you can see in the footnotes about this. When it comes to remuneration of issuing letter of guarantees, and I have again, I mean, we are sort of some things which I'm stressing because these are the key consideration which we have to keep in mind, is that we have to see, the main difference. So one main difference was there, of course, the two separate agreement, which is easily understandable. Other was how the guarantee will work, because this is a risk sharing, but there is sort of guarantees. So how we brought in the kafala concept. Again, this was a lot of consultation we did to bring in this element. That is something which was generally we didn't find in other bespoke documentation which we were shared by our member institutions when we were developing these standards. So that is something which we provided. And then you look at element of the guaranteeing aspect of an element of how the fee is shared. So fee is, like I explained earlier, is not for providing guarantee or LC confirmation. So that fee grantor can only share with the participants, or one participant or number of participants, based on the administrative fee expenses. So this is allowed by Sharia, it's permissible. And such services are generally for providing services such as feasibility study or assessment of transaction or verification of documentation. So you can see there is a lot of transparency involved when it comes to the arrangement between the grantor and participant. so they can see everything. So this is something, a Sharia requirement, which we have to abide by and which we have to take into account. And those are clauses 6.1 mentioned. Particularly for unfunded, you have to keep in mind that when you're doing any guarantees or LC confirmation or such instruments, you have to have fee to be shared on the service fee basis. The fee, the way it's done, if you can go back to that slide, please. The way this fee works is for funded, is especially for these services. Itself, we have to keep in mind that whatever the fee sharing between the participant and grantor, it has to come out from the transaction itself. So it cannot be that grantor pays the fee from some other sources. So the fee has to be generated from these actual transaction fees. Another aspect which I already touched upon is the assignment and transfer. And this is something which, again, to be stressed, that we sort of have to see the Sharia compliant, and the internal sort of Sharia board of institutions, they have to monitor that when the assignment is taking place, or you're bringing is sub-participation, which is at times is a major, as an institution grantors or as a participant, as a major sort of strategy they have to bring in some other participants, maybe to reduce the risk and move into some other transactions, whatever the reasons they have to basically do it on a Sharia compliant manner. So these are very broadly sort of something which we have to keep in mind, broadly not doing any thing to do with discounting per se is very clear. This is something which we have to keep in mind, that wouldn't be allowed from Sharia perspective. Of course, grantor, it has several duties, and we sort of explain that grantors have to share, whatever the document it has for assessment, and also there is element of transparency there. There is also, when there is a, let's say the fee is received is more than what was agreed with the participants, so whether it can retain that share or it has to be, it can share with participants. So we have sort of clearly mentioned what is the possibility if it is basically this, the agreement says that we are going to share this X amount, then that the amount it will share, and if it is there anything X above that, naturally that can be kept by the grantor. So this is something we have to see, and naturally when they are doing these transactions, a grantor is liable to administrate these transactions and the same degree of care which is like itself what it is doing. Termination of agreements, which is agreements of MPAs, if they want to terminate mutually, they can do a written notice and can terminate, subject to, of course, the transaction which were concluded under the both MPAs. They have to be basically, all the conditions have to be met. So transaction itself may continue, but party may decide to negotiate and end these MPAs, which sometimes may happen in the normal course of business with their counterparties. Now looking at the AOFI standard 23 and why it is so important, I think this is something which is critical for us to also be mindful that when you are entering to the agency agreements, these are sort of equity type. They are not really binding in that respect. So they are not really binding like if you enter into a leasing or ijara contract or muraba. Those are more binding contracts and more credit intensive contracts. Of course, agency, unlike those, are not really as credit intensive. However, if you sort of look at it from the perspective of AOFI standard, the agency can be binding, subject to mutual agreement. Of course, there is always a mutual, you have to be. So one party cannot just voluntarily decide and take action and leave. So both parties have to voluntarily agree. There is what we call a paid agency, and there is a small fee generally. It could be $100 also, for example, to enter into a binding agency contract or arrangement. And that arrangement, of course, has to be as per mutual consent if they want to be terminated. And this is something which from IIFM, we have our liquidity management standard based on unrestricted wakala. That's also we recommend that the approach of when you are entering into this agency agreement, it will be better to use a fee-based wakala. So bring in that concept of binding so that you have a better sort of arrangement between the grantor and participants. One of the things which we sort of also, we have done a few workshops, IIFM itself, in the last 1.5 years or so, and we received some comments also as well when we are both from jurisdictional level, maybe from regulators or from the institutions. And one of the things which has to be kept in mind when we are sort of doing these sort of transactions, especially referring to unfunded, when you have a fee for LC confirmation, for example, or for example, guaranteeing, you are basically have to look at AOFI standard 47, the rules for calculating profit in Islamic transactions. So when you have this unfunded and you are calculating, so what you are going to calculate a fee as a one number. So it has to be, X number, and that has to be fixed for the term. And then what you happen, you can believe, although, I saw Bob mention about the IBOR reforms, what are happening, and Todd rather mentioned, and then that's something we are also looking at it, from Islamic perspective. That's another topic for IIFM. We are tackling that, going to tackle that as well, is that we have to, sometimes the banks may use the LIBOR as a benchmark. So this is something has to be very clearly to be understood, that those are merely a benchmark. So you have an amount which is there, let's say 2%, whatever, and then you can benchmark it with the 6-month LIBOR and all. So that is how this works. And I think we have to also use this sort of important consideration. And another important consideration in this respect is that the fee has to be cannot be exceeding what is in the market, international market. So when you're doing, you have to keep in mind that these fees are basically within that. So it could be less, but cannot exceed. So let's say if you're conventional, you are charging a fee for certain exposure of 2%. So Islamic, they can do it based as a benchmark, they can use that, but they cannot exceed that. So this is also bringing the fairness that you can allow to do that. Of course, if your balance sheet allows, if it maybe, or if you want to be sort of competitive, you can sort of keep it, within sort of that range or reduce that fee. So this is something which is allowed as a reference, and I think this context, because we receive very specific queries on this subject, we have to really stress on this point that you have to keep in mind that although LIBOR or IBOR as such is not used as calculating, but it can be used for benchmarking purposes.